You're listening to Legends, a RenMac podcast with open conversations with some of Wall Street's most influential minds. I'm Jeff deGraaf. Today, we're going to talk with Walt Deemer about the elevated bullish sentiment in today's environment, some stories from the nifty-fifty era back in the early 1970s, differentiating good investments versus good companies, the importance of expectations versus narratives, and how it applies today. We hope you have a great holiday weekend and thought this would be a great way to kick it off wherever your travels may be taking you.
Good.
Walt Deemer, my old friend, it's great to see you. Thank you for joining us today. We want to take some time this 4th of July holiday to talk about the current market environment and just, something that I'm getting a sense of, and I wanted to see if you're feeling the same way, which is this long-running enthusiasm, this bullish sentiment around AI, and not that that won't play itself out and be a game changer for humanity and the economy and everything else, but just thinking about the difference between, good stocks and good companies and good investments. But I wanted to talk to you quickly, and thank you so much for joining us. The recent
Thank you for having me.
Well, always a pleasure. Anytime you want to come on, you let me know. The recent sentiment figures have shown an elevated number of or percentage of market bulls. You and I both know this can often be early, so that's something to keep in mind. But it is a good time to step back and gain a little bit more perspective, particularly on the bull case. And I know you're a card-carrying contrarian, so I just want to get your take on how you think about the survey data, how you use it, particularly because it usually requires us to be sellers of good charts. And I know that's something that we don't tend to want to do historically. So I thought we'd tap your wisdom in the 50 plus years that you've been doing this to get some sense as to how you handle environments like this.
Well, thought number one is I was never a fan of surveys. I was always a fan of using actual trading data. We used to get a lot of trading data from Merrill Lynch back in the old days. I don't know what's available now. I know Goldman has some stuff, but surveys are what do you feel, and actual transactions are what are you doing. But the other thing is, if you have to look at an indicators to see whether sentiment's over bullish, it isn't. So when it gets overly bullish. And right now it's overly bullish on the AI stocks. How much more overly bullish it gets, one does not know, but one knows. So it's sort of the sentiment to me, Jeff, is it's a warning sign. It's a sort of like a get ready to sell signal rather than a sell signal.
And when you so you don't rely on surveys, and that certainly is fair for someone who's been doing it for a long enough period of time. You do get this sort of sixth sense, if you will. What was it? Gladwell talked about the 10,000 iterations or whatever it takes to kind of become an expert in the field, and I think maybe I'm there, and I'm pretty sure, confident that you're there. What are some of the things?
I'm about 8,000 behind.
What are some of the telltale signs, if you kind of think back through your career, that really mark those points where you said, you're right. I don't need survey to tell me that people are bullish. But what are some of the softer, more qualitative aspects of that you've found to be useful?
Well, the problem, Jeff, is it's an area rather than a pinpoint. So that sentiment is overly bullish, but it may stay overly bullish for a while, longer than you can stay solvent if you're short. So it's sort of you're not in the early innings, but you're not necessarily in the bottom of the ninth. That's about the best I can do. I was never, maybe other people have found a better way to do it, but I'm just never able to use it as a sharp sort of indicator timing tool. It was more a general climate tool. Either people are really, really bullish or they're really, really bearish. but they can stay really, really bullish for a while, and they can even stay really bearish for a while sometimes.
Yeah, we call those zip code indicators. It'll get you into the right area, but you're not gonna meet up with your dinner or lunch companion if you're just using the zip code.
Yeah, good point.
Indeed. So with NVIDIA, let's talk about, and we don't have to talk about specifically NVIDIA, but I think that's the poster child here today. In your experience, and maybe as important as anything, how should we differentiate between a great company and a great stock or a great investment? Because they are not
Right.
they're not always similar or the same.
Can we do
Talk to
the,
us a little bit about that.
okay, can you do the McDonald's chart?
I can do whatever you want. There's the McDonald's
Yeah.
chart right there.
Okay, there's the McDonald's chart. Okay. This was one of the poster children of the Nifty-50 in the 1970s. And McDonald's went straight up into 1973. And uh, everybody was investing in just the Nifty-50, as I'll show you in a minute. So McDonald's goes up. Putnam, where I worked, was one of the big proponents of growth of Nifty-50 stocks. Carl Hathaway at Morgan got more of the press because he was in the media capital of the world. But we were every bit as much. And one day, we were getting all sorts of clients. They were jumping ship from the people that weren't performing and coming over to us because we were performing, because we were in these suckers. And so one day, John Maurice, who ran the growth fund and was probably the best money manager Putnam had, looks at somebody from the advisory company, which is getting all these new pension fund accounts, coming in with a stack of buy tickets and a stack of sell tickets. The sell tickets were all from the account that they had just inherited, and they were getting rid of all that crap. And the buy tickets were the Nifty-50, which were doing so well. And John Maurice looks at the guy and says, "Can I ask you a question? Have you ever wondered whether US Steel, which you are selling at 5 times earnings, might be a better stock than McDonald's at 75 times earnings?" And the answer was no. We were sold to the client as a growth stock manager, and a growth stock manager we shall be. So people like us were putting the top on McDonald's because we didn't care what we paid for it. It was the stock that was, generating our performance, and we put the bottom on US Steel. And so that's sort of the way it goes. You don't know where the actual extreme is, but it's getting there. And this is my favorite chart, Jeff, of all time, because it shows that little line that goes from southwest to northeast is the earnings line from Securities Research, the Securities Research Blue Books. It's a monthly chart. And when the price is on that dotted line, it's selling at 15 times earnings. When it's above, it's more. When it's below, it's yet less. So McDonald's, when we were buying it at 75 times earnings, was about to embark on an unbroken run of 20.5% growth compounded for 7 or 8 years. Never missed a single quarter. And the stock was cut in half. So McDonald's performed every bit as good as the fundamental analyst would think. But it turned out the market said there's a limit as to how much you pay for me. And it turned out that 75 times earnings was that. Now, where that is in NVIDIA, I have no idea. I may not live long enough to see it. You may not live long to see it, but it will be there sometime. It's always happened before in all these poster children's, and it will happen again. I am convinced history repeats. It rhymes at least.
Yes. Well, and I think it's a really important point in that the earnings line, and to your point, the analysts were right. The company performed, they executed. It was no fault of their own that they did something. It was that the expectations and all those bullish expectations were built into the price. And it got to a point where it became saturated, and there was just the incremental buyer was very, very difficult to find after that point.
Right.
And
And
lo and
and
behold,
where where that exact point is really something you only know it's in hindsight, but you know it's going to be there.
correct, right? And so, what are some of the telltale signs? Are you a big fan of stock not responding to bullish news? How do you think about some of those telltale signs in terms of the tape? What are some of the messages of the tape to give you some warning, some inference that maybe this thing has in fact run itself out of steam?
Well, one thing, Jeff, might be if some of these stocks don't go up on good news. Another thing is if they just stop going up. Um, Another thing would be if something else takes over as leadership. So you say maybe I reprinted a piece I did in 2000 when people were buying Cisco at any price, and I wrote a piece entitled "Arrogance," which was, the Cisco is a great company, but there's a limit as to how much you pay for the stock. I happened to choose Sears Roebuck as the counter, which wasn't a good example, but I said, at what point does Sears become a better stock to buy than Cisco? And the answer never is not acceptable. And I said, so I updated, I said, substitute, at what point does Oxy Petroleum become a better stock to buy than NVIDIA? And the answer never is not acceptable. I don't know where that point is, but it's there somewhere.
And as a momentum player, how do you differentiate between bad momentum, which is momentum that's peaking and reversing, and good momentum, momentum that has sustainability and likely to continue? Do you have any tricks up your sleeve, Walt, that you can share with
I
us?
I do not. I am sorry.
That's a fair answer. That is a
The
fair answer.
only trick I have is Bob Farrell's old rule that uh, parabolic advances usually go further than you think they will, but they do not correct by going sideways.
Mhm.
But the trick is it's got to be parabolic on a log chart.
Right, right, right. And the point
And
being a log chart is giving you the geometric returns so that a
right,
50% return looks the same on the chart
right,
versus an arithmetic return, which is going to look a lot more severe in
correct.
um, in a in a visual format.
Yeah, it's like the
Excellent.
old trick. It's the old trick with the national debt. If you use an arithmetic scale, it goes along the bottom and then goes straight up like a hockey stick. If you use a log chart, it looks you're getting percentage comparisons, so it's much more meaningful.
Yep, indeed. Thank you for that. So let's talk a little bit about the late 1960s and 70s. This is the S&P 500 back in the day with the 50-day and the 200-day moving average. It's a pretty tumultuous time. You had a couple bear markets in short order. Obviously, inflation was rampant. A lot of people want to draw parallels today to what we had back then. So far we haven't seen anything that's been nearly as disastrous. I mean, COVID was clearly more of a 1987 type of event than a 1970s type of event. But walk us through kind of what was going on back in this time frame, Walt, and maybe some of the war stories from this time.
Well, the big thing then was uh, the S&P. The peak on the left was 1968. Then the next low was 1970, and then it went up to a 1973, which was high, which was a much higher high. And if you can go to the next chart, which is the indicator digest average, this is an unweighted average of the average stock on the New York Exchange at the top and the average stock on the American Stock Exchange at the bottom. And you can see it made a peak in late 1968, it made a low in 1970, but then the New York index only came halfway back. The Amex index hardly came back at all. And so the point being that the nifty-fifty growth stocks were going up and nothing else was, hardly anything else. And the reason that has stuck with me is that this did not end well. The New York Indicator Digest average ended up down 75% from its 1968 high to its 1974 low. The American Stock Exchange unweighted index was down 88%. I mean, it was but you can see on the American Stock Exchange, there's no rally. It was a huge rally failure. So the point being is the averages, the indexes were giving a much terribly misleading picture of what the market, quote, the market was doing.
And as you look at it today, do you see something similar, or this appears to me to be far more severe than what we're seeing? I mean, obviously we've got relative underperformance by the Russell 2. I mean, it's kind of this listless trying to break out market in trend, but it feels like the bad charts are about relative performance, not about absolute performance. Would you agree with that, or where do you stand on that today?
Yeah, I'd agree on that. But as a money manager, you live and die by relative performance.
Yeah, sure.
So, if you tell a client, well, we were up, but not as much as the other guy, the client is going to be a next client.
Correct.
Yeah.
Never happy with that.
And as I say, the thing is, to me, Jeff, this is only one illustration from the past, but it didn't end well. 1973-74 was a hard bear market. That doesn't mean this next one's going to end up as a hard bear market. But good things did not come out of that huge divergence between the clear leadership, in that case the Nifty-50, in this case the Mag 7, or however many, and everything else. And it just, money was pouring it from everything else right now into the Mag 7. At some point, it's going to reach a breaking point. The rubber band is going to be stretched too far. I don't know where it is. Maybe here, maybe today, maybe 5 years from now. I don't know. Probably neither. But the thing is, people have to think is, in my opinion, is the choice is NVIDIA is clearly a market leader. It's clearly done very well. But right now, today, is NVIDIA a better stock to buy than Occidental Petroleum or Cat Tractor or some other heavy industrials? Is it a better buy than some mining stocks? I don't know. There's a point somewhere where those other stocks become a better buy than NVIDIA. It's not NVIDIA forever. It won't be. It just seems that way, and it certainly has been forever for a long time. But unless we're all going to have 5 of those chips in every room in our house at some point, there's a limit.
Yeah, I mean,
I don't know where it is.
Well, one of the things I think you're talking about too, right, which is so important, and we try to you can't eliminate it, but we certainly try to minimize the impact of narrative, right, in the investment decision, because narrative is so seductive. It's so easy to buy into, and to really give you this false sense of security. And, to your point, even if there are 5 chips in every house, if that's already discounted, in terms of the valuation, in terms of the positioning, it's not going to matter. It's going to require 10 chips, right? And that's that's always the challenge. Let's talk a little bit about Xerox here. This is an old school chart from the 1980s, but hopefully viewers can see this. What was the point here on Xerox? Which, by the way, and I know you know this, was really the precursor to Microsoft Windows and the Apple operating system and all the fancy user-friendly, shall we call it, mediums to get the PC into the state that it reached in the 1980s. Xerox really dropped the ball on that, but clearly the stock suffered as well.
Yeah, but here again, if you look at the earnings line, with the exception of the mid-70s, was essentially going up and the stock wasn't. So sometimes just because the earnings are going to go up, it doesn't mean the stock is. Two different things.
Right.
See, Jeff, I got to confess, I never worked for Warren Buffett. So I look at stocks rather than companies. He looks at companies. He buys the whole bloody thing. And if I looked at companies, I would probably think a lot differently. But we don't buy companies, we buy stocks. And they're not the same thing as a company.
Indeed. And then we wanted to talk about going back further, even about 100 years ago here, looking at what was in its day a tech of all tech stocks, right? The old wireless and getting RCA into the mix here.
Yeah, exactly. I just threw that into the mix, Jeff, to show that it's happened 100 years ago as well as more recently. RCA, I mean, radio was probably the greatest, growth industry going back in the late 20s. I mean, it was just coming on. Everybody was buying radio. You literally were going to end up with a radio in every room just about.
Right,
But the stock went down 90%.
right, right.
So,
Uh,
so
and and we all know that the radio's dominance continued from that peak for another, what, 25, 30 years
something like that.
until
Yeah.
television, right? And
Yep.
still remained ubiquitous
Yeah.
in households across
Yeah.
the country and the
Yeah.
world.
Yeah. Now, unfortunately, I don't have examples from the go-go years because most of the stocks don't exist. So things like Four Seasons Nursing or National Student Marketing or Resorts International, uh, you can win bets at a bar by asking somebody what was Resorts International called before it changed its name, and the answer is Mary Carter Paint. That's how hot the gambling stocks were. So Barry Carter Paint decided that they were going to paint a casino in the Bahamas, and now it's a Resorts International. So, so it's happened before. You had a wave of speculation in the late 60s in the really aggressive stocks, speculative stocks, and then you had another wave of speculation in the early 70s in the nifty-fifty stocks. And I was kind of fortunate because I was at Jerry Size Manhattan Fund in the late 60s. So I saw all of that stuff. And then I saw the speculation in the nifty-fifty in 1970s from Putnam. So it's a movie. The movie isn't the same every time, but it's not, it doesn't have a different ending usually.
Right. I was at a lunch earlier today, and two things really jumped out to me. One, which I was not aware of, is my understanding is that there's actually an NVIDIA ETF, which is levered. So if you don't
Yep.
want to own it yourself or put on the leverage yourself, you can just own the levered ETF, which
Yeah.
certainly has the earmarks of, let's put it this way, they're not doing that with Occidental Petroleum, are they?
No. No.
And the
But
other is, and I've
can
always,
I ask a question?
please, I don't know if I know the answer, but go ahead.
That leverage NVIDIA ETF, can you buy it on margin?
Right, right. I mean, I would guess you can, but I'm not sure. So
Okay.
at your own risk, if that's your cup of tea. The other was that people are using chips now as collateral, which, if there's ever been anything in my 30 plus years in this business, chips are really the self-designated expiration of any commodity, right? That they just keep getting better and better. And so the idea that you're going to use today's chips as collateral for future payments or against loans when I mean it just seems preposterous to me. So some of those signs historically of one-way thinking, I guess is the way that I'd put it, that they can only go up certainly resonates with me, and I'm sure that you've got some similar war stories around those as well.
I have many war stories, but some of them are not acceptable to tell in polite company. But there were a lot of shenanigans going on in the late 60s. The late 60s were the three Freds and a Jerry: Fred Mates, Fred Carr, Fred Alger, and Jerry Sy.
Yep.
And it ended up Fred Alger was goosing his fund by buying a letter, a stock under a letter of intent. So he was buying it at a deep discount to the market price. Then he immediately marked it up to the market price, which he couldn't sell it at, but it gave him a lot of performance. But then when they had redemptions, he couldn't sell it. So there are
Amazing.
always there are always excesses,
Yeah.
and they're a lot of fun when they happen. I mean, speculative markets are a lot of fun. Like in the late 1960s, the American Stock Exchange tapes for all the old timers at one point ran 37 minutes late. I, by the time they shut it down, that they almost had to sell ads to keep the tape moving.
That's amazing.
Yeah.
Well, the good news is I think with high-speed internet and the like today, fiber optics, hopefully that doesn't become a problem, but certainly endemic of that kind of environment. You're absolutely right. I mean, to warn of the speculative excesses is a little bit like taking the tap off the keg at a party when everybody's having a good time, right? I
Yeah,
mean, nobody wants that guy around.
yeah, exactly.
Indeed.
And you don't know there may be another keg out.
Right.
And you finish this keg, there may be another keg. So who knows? But
Right.
eventually you run out of kegs.
Eventually. Spoken like a true Nittany lion right there. Walt Deemer, any parting words? Thank you so much for your time.
Thank you so much. It's a fascinating business. That they say if you enjoy your work, if you enjoy what you're doing, you never work for a living. And I was fortunate because I enjoyed my work for all the time I was in it. And now I just fool around on Twitter and put out little cute things. But
Well, we appreciate the years of dedication, perspective, and always the good humor that you bring to this, and um, hope to have you with us for many, many more years and many, many more conversations like this. So we can always have these great perspectives. Thank you so much.
let me just one quick thing. All the memos I ever wrote are on a website called deemermarketmemos.com. So if you want to go and see what I was writing in the early 1970s, you can go and look them up. There are a lot of charts, and the reproduction quality isn't that good. But if you want to get a feel of what it was like, it's there. Thank you.
Brilliant, brilliant. Well, I'm sure you're going to get a lot of hits on that because I'm going to go to it right after I get off here. So thanks so much for that and with your time, and we'll talk soon. Walt, thank you.
Yeah, thank you, Jeff. It's a pleasure to know you.
Take care. Thank you for joining us for this episode of Legends. We understand your time is valuable, and we hope you were able to take something away from today's conversations. For all of us here at RenMac, have a great and safe holiday, and we'll see you soon. Take care.